Most traders lose money in this exact area and they never understand why it happens. Welcome back to the channel. Make sure you watch this video until the very end because the final part is where everything comes together and where most traders usually make mistakes. In this video, you are going to learn how to properly read market structure, how institutions manipulate price, how to identify a high probability point of interest, and how to plan a sell trade with clear entry, stop loss, target, and risk management. Starting from the left side of the chart, the market is clearly bearish. We are making lower highs and lower lows, which already tells us that sellers are in control. Then we see liquidity being collected above previous highs, followed by a strong break of structure to the downside. This break of structure is extremely important. It confirms that the market is not looking for buys, but is instead continuing its bearish intention. This is the first major clue that we should only be looking for sell opportunities. After this break of structure, price moves aggressively to the downside and later retraces back upward. This retracement brings price back into a premium area where we can clearly identify an order block. This order block is important because it represents the last area where institutions placed large sell orders before the impulsive move down. When price returns to this zone, we expect sellers to defend it again. However, we do not sell blindly just because price reaches the order block. Before price reaches this zone, the market creates inducement below the order block. This inducement is designed to manipulate traders. It tempts early sellers to enter too soon and encourages buyers to believe the market is reversing. This is a classic smart money trap. Below the inducement, we can clearly see sell-side liquidity resting under the lows. This liquidity becomes our final target and gives us a clear objective for the trade. Now, once price returns to the point of interest, we remain patient. We do not enter immediately. We wait for confirmation that sellers are stepping back in. The entry is taken only after we see rejection and bearish confirmation inside the order block. This confirmation shows us that institutions are active again and that the probability is in our favor. The stop loss is placed above the order block, not directly on the high, but slightly above it. This protects us from liquidity grabs and long wicks that are meant to take out weak stops. The take profit is set at the sell side liquidity below the lows. This is where the market is most likely to deliver price, because liquidity is the true target. Risk management is non-negotiable. You should never risk more than 1 to 2% of your account on a single trade. One good setup is meaningless without proper risk control. Trading is not about winning every trade. It is about executing high probability setups consistently with discipline. If this breakdown helped you understand the market more clearly, make sure to stay connected. In the next video, we will go deeper into confirmations, lower time frame entries, and how to avoid fake setups.